Welcome to Volatility Trading Strategies. So today I'd like to go through a full explanation of the VTS Iron Condor strategy. This is a remake of an old video, but in the interest of transparency, I never delete anything from my website, so I'll leave a link to that old video. It's more or less the same, but there is one small change this year to how we allocate positions, so it does require a new video, but let's get into it. So the first question I want to address is, why should we trade derivatives at all? What's wrong with just investing in traditional asset classes like stocks and bonds? Well, nothing. Traditional asset classes also make up the core holding within my portfolio as well. 50% of the total portfolio solution goes towards what we call the tactical balance strategy, which rotates between positions in stocks, bonds, or gold, depending on market conditions. But I view derivatives investing as an asset class of its own, and a great way to add diversification to any portfolio. Many people aren't aware of this fact, but the global derivatives market is actually larger than all the world's stock markets and all the world's bond markets combined. Now, the term derivative is very broad, and what I'll be talking about today is just a very small part of that derivatives market. But I believe the diversification it brings is vital to long-term investing success. But let me get into a little more detail now and address the question of why trade Iron Condor specifically. So this is a chart of the Russell 2000 index with today's price right there at 1372. Now we can say a lot about how we got here and what caused it, but what we don't know is where we're going next. Anybody who says they know, of course, is just fooling themselves. I can draw a little price line here. 2 months from now, we really don't know where we're going to be. Will we be above this line? Will markets crash and go well below this line? Nobody really knows. But we do know that there's a 68% probability that we'll be within one standard deviation up or down from today's price. And we know there's a 95% probability that we'll be within 2 standard deviations up or down from today's price. This goes back to all those very boring statistics classes that we all took. I was actually one of the weird ones that went on to study math and statistics in university, but for most people, they really did hate those old stats classes. But even if you did hate them, you probably still remember the standard Bell distribution. Future occurrences tend to gravitate towards that mean, and we have increasingly less probability of seeing values further away from this mean. If we flip this on its side, we can apply it to my trading example. Imagine this bell curve with the mean centered right on this price line. That's today's price of 1372 on the Russell 2000. Now, without knowing what future prices will be, the odds are much higher that it'll be somewhere near this mean, rather than prices further away from it. Now, of course, we might see a crash well below it, or maybe just a nice rally that takes us way above it. But most likely it will be closer to this mean. And that's exactly what we see in the markets in the real world. We are, of course, emotional creatures, and naturally we fear those big crashes. And of course, we hope to be there for the big price increases, to ride those rallies as high as we can. But in reality, markets spend the vast majority of their time just chopping around this center line, not really making any major moves in either direction, at least in the short term. We're talking about 1 to 2 months from now. So the VTS Iron Condor strategy doesn't actually have to make any market predictions. We don't have to know whether markets are going to go up or down. We just have to understand probability theory and design a strategy that effectively exploits that. And if you have been following my work over the years, you'll know that that's a theme that's constantly reoccurring. Remaining quant-based, systematic, and removing our personal predictions from the equation and just focusing on the probabilities. And the Iron Condor option spread allows us to do that. So what you're looking at here is your typical Iron Condor option spread. This is today's price right there, that little gray hash mark, 1372 on the Russell 2000. And all of this here, this is our profit range. Above our strike price and below our strike price, that's where the losses occur, right there and then over there. Now, we don't actually hold our positions open until option expiry, but as long as the price stays somewhere in this range, closer to that center line, we will be profitable. Now, of course, there are times that it doesn't, and that's when risk management and stop losses, for example, come into play. But like I said, most of the time the markets are pretty uneventful, and in the short run, we just capture that easy profit in this middle range. It is also important to note, though, that while Iron Condors that may have already been open, if there's a market crash and you have a trade that's already open, it's very likely that that trade will hit its stop loss and you'll take some losses. But if you open new Iron Condors during times of extreme volatility, say immediately following a market crash, they can actually do very well because the premiums that you're bringing in for the trade actually extend these strike prices quite wide. So you can cover a very wide range of future prices. So, the iron condors, of course, they can lose money. All trading strategies can. They suffer drawdowns from time to time. But iron condors are great because they can recover losses quite quickly, sometimes a lot more quickly than other trading strategies can. So if we want to view this trade into that original chart, we've got strike prices of 1500 and 1250. On that chart, it's going to look something like this. So hopefully now you can start to see why the iron condor is such a powerful option spread. Because if we do want to capture that profit and have the highest probability of being successful going forward, into the unknown of course, because we don't know where we're going to be 2 months from now, we need to cover as much of this area as possible, because that's where probability theory tells us that future prices are most likely going to be centered. And that's exactly what the iron condor is designed to do. Again, this strategy is not about making market predictions. That's unreliable in the long run. It's about using statistics to our advantage and maximizing our probability of success on each trade. Some of them will lose money, of course, when markets make larger than expected moves. But the goal is to have many more that win, and in the long run, achieve a decent rate of return. Now, this is option trading, so there is a little bit of a barrier to entry there. Most people don't have experience in this space, so I understand it can be a little bit daunting at first. The thing I would like to convey to people, though, is that option trading itself has been around for decades. It's certainly not going anywhere, and neither am I, so please take your time. It's not nearly as complicated as it may appear on first glance. Once you get a few trades under your belt, it'll all be smooth after that. But there's certainly nothing wrong with following along for a few months in a paper trading practice account. Whenever there is a trade to take within the strategy, I email out all the necessary information to open or close it. And again, it may look complicated at first, but after a few tries, you'll just glance at the email and you'll know exactly what to do with it. This is an example of what a daily trade looks like. It'll say in big bold red letters, "New trade required," whenever there is one to take. Below that, all the details to set up the legs correctly. Your trading software will allow you to open the whole thing as a single trade, but you do have to check the individual strike prices and make sure they are correct. You'll sell the middle strikes and you'll buy the further out strikes. And then below that, there's always a picture with the same information. Depending on how you like to view it, you can use either one of those, but they are both there. That bottom part is important as well, but very simple to use. The new change this year is that we'll be dividing the money up into 2 parts, so we can take 2 smaller trades more often rather than 1 larger trade. You'll just divide whatever amount you've allocated for iron condors by $5,000, and that's how many contracts you open. If, for example, you have a $10,000 allocation, divide by $5,000 and you'll be opening 2 contracts. If you have $50,000 to dedicate to the VTS Iron Condor strategy, then divide by 5,000 and you can open 10 contracts. So overall, it's very easy to follow, and with a little bit of practice, you'll be able to execute these trades very easily. Allocations do change from time to time, but currently the VTS Iron Condor strategy makes up 20% of the total portfolio. And since we're dividing it into 2 smaller trades for 10% each, and we use stop losses set around 5 to 10% for each individual trade, we're targeting a pretty low allocation of total assets here, but definitely enough to achieve our goal. I'm a conservative investor. I'm patient, and I do try to remain focused on the long run. Diversifying a small amount of capital towards a market-neutral option strategy like iron condors is, in my opinion, a great way to reduce correlations and improve long-term performance. So if you have any questions at all about this strategy or any of the other ones, feel free to reach out anytime. I'm always here to help. Thanks for watching. So go ahead and click the link right here, sign up for the VTS newsletter, and when you do, you're going to get full access to all of my trading strategies for a full month absolutely free. And if you are new here, please consider subscribing to my channel. Also, if you have any questions or comments, I'd love to hear from you. So go ahead and leave those in the comment section below. See you next time.